This is Scott Becker with the Becker Business and the Becker Private Equity Podcast. I'm thrilled today to be joined by an unusually great professional and person. We're joined today by Eric Mangold. And Eric is the founder of Argosy Wealth Management. He's going to talk to us about this, and just a fascinating and great person. Eric, we'll talk about trends. We'll talk about what you're focused on, advice for evolving leaders and founders. Take a second and tell us about Argosy Wealth Management. What made you start this, and how does your approach differ from sort of traditional CPAs and advisors?
Well, first, thanks very much, Scott, for having me. Always a pleasure. And again, great book of building great businesses. Just finished it last week and it was awesome. Yeah, Argosy Wealth Management. So I've been a financial advisor for 16 years. I originally studied for financial planning out of college. And once I got out of college, I was young, dumb, and poor. And so when I was interviewing at Merrill Lynch to become an advisor, the guy said, listen, you just don't have the resources. I think you have a genuine desire to help people, but I don't think you're ready for this profession yet because you don't know anyone and you don't know anything, and you're saddled up with your own student loans. So he's like, how are you going to make this work? Which I actually thought was pretty interesting advice. So I went out and rounded out my skill set and, went to work for Bloomberg LP, which is an amazing experience, and got a great network of people, learned as much as I could. I've been on every trading floor you can possibly imagine, hedge funds, big banks, small banks, whatever. And then when I was 38, I launched my own financial planning practice out of Guardian Life Insurance. And what I realized pretty quickly was that, when you say financial planning, I think most people think the very similar things: investments, insurance, et cetera. But the culture and how you go by helping your clients is vastly different. And it took me a while to discover that. And then ultimately, in 2022, I was thinking to myself, what the best culture is the one that I think I have to create for myself. Because no place is perfect, but if I can create the culture that I believe clients want to deliver the ultimate client experience, I said, I got to be the one quarterbacking and spearheading that. So in 2022, launched Argosy Wealth Management. It's been a fantastic experience, and we focus on working with physicians. And I think that's about 7 years ago. A friend of mine came to me who's not a physician, introduced me to a friend who is a physician, who's a neurosurgeon. And right out of the gates, the physician and I hit it off. But he said to me, Eric, he's like, I don't know if you can help me or not. And I said, well, I don't know either. Let's just, let's have a chat. First thing he said to me was, I do have this question. He held up his 401k statement. He goes, Eric, when do I have to pay this back? And I looked at him and I was like, come again? When are you going to pay this back? And he said, yeah, I got to pay this back, don't I? And I said, Doc, no, this is your 401k. This is what you're saving towards. This is your retirement. This is your money. And he goes, and we're talking about a neurosurgeon who, and in healthcare, neurosurgeons, that's some of the most competitive jobs that are sought, are neurosurgeons. And he just didn't have the financial acumen. So I often call this the best meetings ever, because the day that I signed we needed to get all the documents signed to implement the plan we agreed to, he was in surgery. And then he was going to go out for a week vacation, then a conference, and he was going to be gone for a couple of weeks. He's like, can we sign this stuff really quickly? So I was like, listen, I can meet up with you right before surgery. He goes, sure. He's like, I'll talk to my surgical coordinator. He's like, if you can be here at 6:30 in the morning, I'll get you in, sign what you need to sign, and you be on your way. I'm like, perfect. So we go in there, and I'm the only bald dude in a suit with a laptop bag with documents in my hand. And I walk in and everybody's in scrubs, and he's like, okay, what do you need from Eric? And I was like, sign here, 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 and here. And his whole surgical team of about 9 people are looking at me and they're like, who's that guy? And he's like, oh my God, this is Eric. This is my new financial advisor. He's like, you guys got to meet this guy. He's doing everything for me. So in the span of about 90 seconds, I walked out with a brand new client and 9 referrals.
But talk about that for a second, because there's so many things that I'd like to unpack for a second, Eric. First is this, and we'll talk about it in terms of business building, because in my experience, it's often been one reference customer, 2 reference customers that lead to all kinds of opportunities. And the second thing is, you needed to be smart enough to connect the dots to see, like, hey, this guy's interested in me, and I've got my eyes open. I'm going to do great work for him and his family. but I got my guys open, I ought to double down and focus on this area. So talk about that, because people think about the thousands of connections. I'm in the media business. People think like, oh, you built this because you're in the media, but you built this because you're in the business. No, no, no. Every single real business development was hand-in-hand comment with a few reference customers to start and growing from there. So talk about that, having a reference customer and you recognizing and connecting the dots to double down on that area. And then we'll come back to financial planning. So we're not talking about necessarily
Yeah.
business development, but about financial planning and some of why you're so effective. And a couple of questions I've had recently from what I think of as really smart adult kids that ask questions. You're like, oh my God, I thought they would know that. Just like you thought your neurosurgeon was at least understand what a 401k is.
Yeah. So when the referrals of that initial meeting, we started having the initial meetings with the referrals on the surgical team. There was this common theme, and doctors don't like talking about money. Most of them don't like talking about money. They get zero financial education in med school and residency. And then they launch into their practice and they're focusing on patient outcomes, not their own finances. They also think that they're behind the eight ball because while most people go, maybe undergraduate, then maybe a graduate degree, doctors are in school for a lot longer, so they feel like they're getting such a later start. Maybe they got med school loans. They feel like they have all these weights of the world just weighing down on them and pushing down and thinking like they're never going to be able to achieve the financial security that they really deserve. Not to mention the people that are healing us, making us better when we're sick or hurt. These common themes kept coming up and coming up and coming up. I kept hearing them, and they're like they viewed money as a taboo topic, and they didn't like talking about it. And they didn't get and they never taught this in med school. So fast forward about 2 years of working with a neurosurgeon, I said to him, I pulled him because we have actually become pretty close, and I said to him, I'm thinking about specializing and working with people just like you. I said, because I'm hearing the same stuff over and over and over again, the same complaints about how you guys are treated. Not to mention, you guys have very high expectations. You feel like everybody's in your pocket because it says doctor after your name. And this is what I want to do, and I want to do the things I did for you for people like you. And he said to me, Eric, how can I help? And so right from there, he's like, I think it's a great idea. He plugged me into a couple of associations that he's part of. I spoke at his facility. I don't even know how many times now, but I've spoken to not only physicians, but physician assistants, some LPNs. And it's shocking because they just didn't get any attention. And it's having that specialization and listening to what they were talking about. I think with any business, right, Scott? Like you listen to what the pain points are, and you're like, I think I have a solution for you that I think can help you.
No, and I think that's fantastic. In terms of money management today, so many different things coming up. I was talking the other day at an event with one of the largest banks in the country, and we're talking about employer-sponsored plans and the introduction of alternative assets over time into employer-sponsored plans. And of course, to me, this sounds half crazy, half okay, especially in large plans. It seems so much driven by the industry versus necessarily by what's good for investors. How do you work through this when a neurosurgeon client or somebody says to you, my friends are all investing in some private companies and private equity stuff, some real estate. How should I think about that in the context of my entire portfolio?
I think you hit the nail on the head. As you think about it in the context of their entire portfolio, I think a lot of times, and I hear this as well in the feedback, is when doctors are on the golf course or at those conferences where they're getting together, they like to talk about that shiny investment. They like to talk about that IPO that killed it, and they like to say how much better their investments are doing than everybody else. But when we look at overall money management and investment management, we're trying to do a couple things. We're trying to grow wealth, we're trying to protect wealth, and we're also trying to save our clients about dollars in taxes. And it's not always hitting that home run ball that is what's going to help you win the race, right? Because if you think about it from a baseball analogy, home run hitters do well. I mean, I'm a big Phillies fan. My Kyle Schwarber right now is leading the league in home runs. What's he also leading the league in? Strikeouts, right? So if we can hit some triples, a lot of doubles, and a lot of singles, we're going to do really, really well for our clients.
Yes, 100%. And it's fascinating about baseball, though, because baseball's actually gone the other way and probably not the way for us to think about investing, because baseball's really gone to this concept that's almost the venture capital concept. more and more money focused on guys that can hit 230, but hit 30 home runs a year. I mean, it's really fascinating how baseball has changed from small
Yeah.
ball to that. It's almost how basketball has changed to the 3-point shot. I mean, it's really fascinating to see the analytics and stuff like that. But I agree with you 100%. I'm a huge fan of the oldest adage in the world. The first goal is not to lose money, and then it's to start making money on that and staying ahead of inflation. Talk to me about this issue. So one of the, kids went into the Fidelity office the other day, and the Fidelity person said, in that, one of our children is 22, just out of college, just starting, has a little bit of money put away, but not a lot, of course. And the guy says to her, one of the first things you got to do is put money into a Roth IRA, put the max into it. And I was a little bit like, I get it, but I was also a believer of she's got to have some money outside of, tax deferred stuff that's easy to access. She's got to have some money in an emergency fund. How do you talk to an investor who's got, you know, 30, 40,000 in net worth versus an investor that has $1 million in net worth? Just very quickly about Roth IRAs, and things like that. I was curious, and then we'll go back to what are the big trends you're watching in a portfolio management. But I'd love 2 seconds on that. Is that something that financial planners are using a lot and encouraging a lot?
Yeah, I mean, definitely. But the thing is, I also, when we're making decisions and making recommendations for clients, is the first thing I have kind of like the 5 basic fundamentals of any financial plan. Really quickly, you got to get organized. Second step, protect what you have, because once you've built wealth, you don't want to lose it. So protect what you have. Third step is, what are you saving? Okay, how much are you saving? It's got to be, 15%, whether you're making 100 grand a year or 3 million a year, you got to be saving 15 to 20% of your income. Okay. Having that emergency fund, 3 to 6 months of expenses, right? And then fifth is pay down any kind of bad debt. What didn't I talk about? Rates of return. Right? Those 5 blocks are the fundamentals of really any financial plan, because if you cross off all of those 5 blocks first, then the kind of the world just opens up to you. You're able to build wealth. You're able to protect wealth. And when life, going back to baseball, when life does throw you that curveball and there's something that you need to handle that may cost money to do, if you don't have that emergency fund, I don't care what you have in your Roth, because then you're all of a sudden, okay, now I got to go to credit cards. I got to take a loan out. No, if you've got the emergency fund, that's a great way of saying, okay, life throws me a curveball. My emergency fund is what is going to take care of that. I had a client one time call the emergency fund her chaos fund. And I was like, why do you call it the chaos fund? And she goes, Eric, because when chaos ensues, that's where I go to pay for it.
Totally, totally. So talk to us about what trends are you watching in financial management today, wealth advisory today. I mean, we could talk for literally hours about one of my favorite subjects, which is how you built your business and built your practice, because that's a near and dear subject to my heart. But I do want to talk a little bit about what advice you're giving to clients and how you think about portfolio management today. And just let me get you started, and then we'll come back to some of the old adages like the 60-40 rule and how much money you should have in an emergency fund, and mutual funds versus individual stocks versus index funds. But give us a sense of how you think about portfolio management today.
So one of the biggest trends that we're watching and that we're actually employing is, are we working with a direct indexing strategy with a tax loss harvesting? So it's getting a little more, in the weeds with this, which is fine. But most people, when they buy an index, they buy an ETF or they buy an index fund like the S&P 500 or the Russell, because buying all 500 constituents of that index can be time efficient, costly, and it's something that doesn't necessarily generate a lot of results. But what we do, we have an investment system that we have that is buying the constituents of an index and then use active tax loss harvesting to harvest losses throughout the year. And what we're finding is that not only are we able to grow a portfolio, but we're able to save clients significant amount of taxes. A lot of times I get the question, I'm like, oh, well, saving taxes, isn't that what the CPA does? And a CPA, don't get me wrong, is a great and vital component of someone's financial plan. But when we do as financial advisors, right, we're going to be doing tax planning, not tax preparation. Tax planning is, how can we save a client tax dollars today, tomorrow, and 20 years from now. And over the course of a relationship with our clients, which obviously we always seek out the long-term relationships, we can save our clients 7 figures in taxes and possibly more just by the strategies that we're using. And these are some of the new and innovative strategies that we're employing, so much so that there's a lot of companies out there that are then, trying to copycat those strategies as well. So clients want to know, can they grow their wealth and can they save money in taxes? And the answer is they can, by employing some of these, I'll say more sophisticated strategies, but strategies that ultimately are producing results.
100%. Where do people go wrong in their financial planning? Where do you see some people make big mistakes? What do people not do or think about avoiding?
So, if I was going to retile my bathroom floor, I could probably get it done. And Home Depot says, come up for your DIY projects and we'll get it done. Let's build this together. But I'd much rather take somebody that's an expert in grouting and tiling than have me and do it in 2 hours versus me do it in 2 months, right? We have a saying, retirement is not a DIY project. And not only do we say that, and people said, well, you're a financial advisor. Of course, you're biased. You want people to work with you. Yeah, that's true. But actually, Vanguard did a study. The Vanguard, by the way, is which the low cost type of financial advising was innovated with Vanguard, right? Low cost funds, low cost ETFs. They did a study a number of years ago that said when clients actively work with their financial advisor over the course of a 20-year relationship, they can actually expect a 2% increase in their overall rate of return. And it's not just from the investment component, but it's also from all the other things that we do as financial advisors, steering clients away from making bad decisions, steering clients away from making emotional decisions, right? We all remember COVID when the market was tanking and people were freaking out. I had to be on the phone with clients sometimes every single week being like, we're going to figure this out. We're not going to sell anything. We're going to be okay. This is going to rebound once we get a handle of this. Well, the majority of the people that, outside of my practice, people that wanted to sell and did sell, they missed the ultimate rebound back up, right? So Vanguard says by working with an advisor, you get a 2% rate of return over the course of a year increase by not working with an advisor. So I think that's really where people go wrong is, they think it's a DIY project, and some of it may be, but working with a professional is going to produce results over the long term.
100%, 100%. Talk a little bit about that. Where else do you see people make mistakes? Do they under allocate to equities, over allocate to equities? Do they try and pick stocks? How hard is it to pick individual stocks? Just give us a few moments on that.
Yeah, I think the individual stock pickers, unless you have the time and the discipline to really allocate towards it, it can be really challenging. I mean, not to mention there's all these YouTube videos and ways that you can look up, guys are making millions for you trading options and trading straddles and doing this strategy versus that strategy. And again, I think really at the core of that are people who are really trying to hit a home run ball with their investments. And again, going back to the strikeout versus home run kind of ratio, if you're always swinging for the fences, you're going to strike out a lot. And, I think people, tend to make those mistakes when they are trying to swing for the fences all the time. And listen, I'm not telling people not to look at different stocks and make some investments in things they enjoy. But that's really what the recommendation is. If you want to make some investments in your own stock portfolio, invest in things invest in things you enjoy, invest in things that you think other people are going to like. Great example. I had a client, and I'm dating myself. Her husband in 2007 walked into an Apple store and to buy an iPod, so dating myself. But he walked into that store and he spent 2 hours in there and he's like, this is the coolest store I ever saw. He's like, this is the coolest store, the coolest products. The people are nice. They're helpful. I love the iPod. He went home and he bought 5,000 shares. That was in 2007.
Take a second, because you're focusing on something that we just talked about on the podcast, I think this week, and it came out of and reminded me of it by reading a recent book called The House of Fidelity, because Peter Lynch was the original proponent of exactly what you're talking about. Talk about how you think about that today, because I love that. I mean, I go into stores all the time, or I use services all the time. Love using Amex. Probably should have invested more in it a long time ago. Saw Lululemon become impossible to shop at. Hated how they treated me at our age, even though it's a great store. They should have listened to those signals. but Lulu's getting better again. But talk about that, because Peter Lynch expounded on that concept of a starting point of investing. Not the end all, but a starting point that you got to still do deep research of those stocks. But talk about that concept of really using your own common sense about what you love and see out there.
Yeah, I mean, because you're really looking at it and you're saying if this is something that I love, enjoy, and the customer experience is great, then it probably would work for other people too. And if it's working for the masses, then it might be something worth investing in. I've got a physician clients who came to me and he said, I'm looking at this specific medical device company. And I said, and he's an orthopedic surgeon. And I said, okay, I go, why don't you tell me about it? He goes, well, Eric, I'm calling to ask you about it. And I said, well, Doc, listen, you're in the OR, you're living this on a day-to-day basis. You tell me about this device company, and then we'll talk about what I think. But I said, I can give you all the information that I can give you about their financials. I'm like, but what's your experience as a surgeon, as a practitioner, as a clinician of using this? Is it helping patients? Is the medical device rep, are they giving you good advice? Are they helping you? Is it something that is economical? Is it easy to use? What are the patient outcomes? And for a good 30 minutes, he explained to me all of the beautiful things that this one particular device is doing for him. And I was like, oh, that kind of sounds like you answered your own question. He goes, yeah, I kind of did, didn't I? Not only did he love the product himself, but he saw the positive patient outcomes. And he's like, I think I have to invest in this. He kind of talked himself into it based upon his own experience that he felt other physicians could use, and for the fact that patients were benefiting from it.
I love that. And take a second on, let me ask you another question, because I love that whole theory. As long as you combine it with, doing some research and understanding what's going on with the company, actually, in the financials and stuff like that. But take a second on, you've built the business from scratch. It's really remarkable. A few pieces of advice that you would give to evolving founders.
When I first started as a financial advisor, I asked the president of the firm, I said, what are the two reasons? I said, financial advisors, he said, the failure rate in 2 years is 80%. So 100 advisors will start today. In 2 years, 80 of them will be gone. And I went to the president of the firm. I said, why is that? And he goes, I'll give you two reasons. He goes, you're starting a business, you're starting a practice of helping people. The first order of operations is you have to be belly to belly with people that you can help. And he said, you got to be sitting across the chair from people that you can help, and you have to have that genuine desire that you want to help them and you can help them. And that's first. You have to never run out of people that you can talk to. So he's like, you have to be putting yourself out there. And he goes, the second reason, you got to be able to take a punch. I go, Scott, I just read your book, right? You know how to take a punch. I know how to take a punch. He goes, you got to be able to take a punch and get back up, because there's days when you're building a business when you question it. You're like, oh, did I make the right decision? Is this for me? Do I pivot? And you got to be able to take a punch. The Japanese have a great saying: it's get knocked down 7 times and get up 8.
It's so funny you mentioned that phrase. When I was a young partner building a law practice at the firm, there was a young lawyer who watched me get abused by the older partners. The older partners were very intent on, this is a long time ago, 30 years ago, and they would say things like, we want you to build your own practice. What they were really saying is, don't do that, because we really need you working on our clients to grow our clients. And so it was very clear that there was this very, very sort of like mixed message about really growing a practice, really becoming a rainmaker. And I was a young lawyer and saw people in their 50s treated like dogs because they didn't have control of their life. And the only way to control your life was to build your own practice within the firm. I didn't want to treat anybody like a dog, but I wanted control of my life. And there was a lawyer, Kurt Foyer, who was a young lawyer at the time, a few years older than me, a young partner, and he was very empathetic. And he came to me one day and said, and he was watching this. Now I'd go to marketing and say, can I get help on something? And they would say, no, not till you're a partner. And then I was a partner. And they'd say, no, not till you're an equity partner. And then at some point I got to have the biggest practice of the firm, and I still then I didn't want to talk to those people. I never wanted their help, but it was fascinating because Kurt was a relatively young lawyer, 5-7 years older than me, and came to me one day and said, look, you're taking a lot of this. And there's a great Japanese proverb, which is the nail that sticks up gets knocked down. And it was very meaningful to me, because he saw what I was going through, and it was encouraging to keep going. Yeah, because it was going well. I was starting to see signs of success, but the signs of success early are very small compared to what you end up with. Just like you, accumulating assets under management and growth starts with a small amount, and you say 80% are out in 2 years. You could be at a small amount of 2 years, but you have to see enough promising signs to keep really going.
Yeah. Yeah.
And you did that.
And also getting, like I said, getting knocked down, and having to get back up just like you did, I'm sure, with building all your businesses. There's times that you're like, oh man, that
Oh my
was a rough
God.
day.
There's a great also adage about getting punched in the face, that when you get punched in the face by a competitor, that's the point at which you're starting to make progress, and you have to recognize it for that. And I won't go into them here. I have a couple great stories on getting punched in the face and what it felt like. And now, when my other leaders or people that are evolving their businesses get punched in the face, I'm able to tell them, no, that's a sign you're making progress. Like, it's also, if you're building a business like you're building, you have to meet a lot of people to start getting them to sign on and join you as a customer, as a client, and you're going to get a lot of no's. And you will have people building businesses that don't even get into the arena because they can't deal with those no's.
When I first started as a financial advisor, one of the guys I became very friendly with in the company, we're at different firms now, and I'm at my own firm, he's at his own firm, but he's still a very good friend of mine. He said, Eric, one of the things I got to tell you is that when you're launching your own business, especially and maybe this is true, Scott, you need to tell me for being a lawyer, is that when you launch a financial advisory practice, he said, it's like you just opened up a bar and the next day all your friends quit drinking. He said, because you'll talk to people, and you're the right person, you're the right fit, you can help the people, and they're just not interested for whatever reason. And you get that, and you get that gut feeling that you're like, man, like I know I'm right for everything, but it just wasn't, for whatever reason, maybe the stars just haven't aligned yet. But yeah, he said, it's like you opened up a bar, next day everybody stopped drinking. And I said, a couple years down the road, I was like, that was such a true statement. Such a true statement. But you have to, if I think, it goes back to your book, Scott, like Building Great Businesses, where you talk about being so passionate about what you're doing. If you don't have that passion, I think if you do get knocked down, it's easier to quit. But if you have that passion, hey, this is my calling in life. That passion, I think, pushes you through those times where, you got punched in the face.
100%, 100%. Yeah, no, I think that's exactly right. And it is fascinating. Eric, give us a sense of where could people reach you if they want to reach you or talk to you?
Best spot, head over to my website, just emangold.com. I have clients nationwide, so there's rarely somebody that we can't help, but emangold, emangold.com. Best place to get me. Some freebies there. There's some free ebooks, videos of talking about the current events in the market, and a spot where they can sign up or book an appointment with me.
Eric, an absolute pleasure to visit with you. Thank you so much for joining us today on the Becker Business and the Becker Private Equity Podcast.
Thank you so much, Scott.